Hi, everyone, and welcome to Sustainability in Motion podcast. We explore the fast-evolving world of sustainability, helping professionals understand how environmental, social, and governance, or ESG practices, are shaping business, finance, and the skills needed to thrive in a changing world. I'm your host, Maisuradze, founder of ED4S. In today's episode, we will focus on outcomes-based ESG data. In the times of ESG backlash, as we're recording this at the end of 2025, it is increasingly important to get our story right and effectively communicate why ESG information actually matters for businesses and for investors. So, it is my pleasure to welcome Pyarali Jamal. We can confidently call you a sustainable finance veteran, I think, Pyarali, having dedicated over 25 years into this space. And you bring a unique perspective, having worked across the financial sector, the corporate side, and also the academic world, both in Canada, US, and globally. So welcome to the show.
Thank you so much for involving me.
Wonderful. So we always start with a journey. All of the guests at our podcast have atypical journeys, so it's totally normal for sustainability professionals. Now, you've been in the space for many, many years, and you've seen the reporting side, the ESG data side. You've been also involved with some of the Canadian universities, and as well as the Institute of Chartered Accountants in England and Wales. Tell us a little bit of what was your journey like? How did you actually get into sustainability, and what was the moment where you realized that ESG data is something that will be important for you to focus on in the career?
Yeah, good question. Well, first of all, I'm Canadian, as you know. I grew up in Vancouver. I am a suffering Canucks fan, and I've been here in the UK and London for over 18 years. Not to age myself too much, but I actually have been working on this for over 25 years. So I led the renewable energy clean tech practice for EY Corporate Finance Canada in the late 1990s, early 2000s. I'm not a chartered accountant. I was in the M&A transaction practice. And that work opened my eyes up to climate change issues, to commercial opportunities in that space, to the impact it has on society. This whole concept of what we now say just and fair and equitable transition, on how industries push back on that, on how we need sensible regulations and all those sort of things, and making the economics work. But at the same time, I was, like many people, I was involved in organizations outside of work, on boards of not-for-profits and so on, in dealing with social issues. And I chaired something called Leadership Vancouver for about 2 to 3 years, where we looked at a lot of social issues. So at the same time as I was working at EY on not just renewable energy clean tech industry M&A work and corporate finance work. Outside of that, I was also quite involved on social and governance issues. And that was quite influential in some of the decisions I made to then leave all that and pursue more education. And one thing led to another, and I ended up in London. So that's been my journey here. I can go into more detail if you want to ask specifics.
I was just scrolling through your LinkedIn profile, and you could scroll for a long time. I invite the listeners as well to do that. And I think you've got so many stories to tell out of the journeys you've been on. But for today's episode, I guess, let's focus on the ESG data and performance. And basically what you just told me is 22 years. That means it's even before the ESG acronym was even born, right? Like this was not a thing when you started. And you started making these connections early on.
Right.
So today we're November 14th, recording this as all the backlash is happening across the world, not only in Canada and US, but also in Europe. So let's start quickly, since the focus is ESG data. Let's talk about what's the status on the regulatory side when it comes to the disclosure, more specifically corporate sustainability reporting directive and the impacts of the watering down initiative of the Omnibus that we've been hearing a lot, we've been worrying a lot. And I just wanted to get your perspective from the European side on where do you feel we are today and where is this going?
Yeah, that's a very important question. You can't talk about data and the use of data without understanding what reporting requirements there are. So look, as we know, as you mentioned, geopolitics is having an impact, including some of the more conservative or right-leaning views that have emerged here in the EU Parliament. And there's a concern, that the EU's various regulations under its sustainability reporting framework is will continue to have somewhat of a negative impact on the economy. In an economy which is already under some pressure due to the tariffs and greater investment requirements for defense here in Europe, and just general concerns about economic uncertainty. So it's not a surprise that there are efforts to roll back some of the sustainability regulations that you mentioned. And there was a reason why I thought it would be good to do the recording today, because I knew that the EU Parliament was going to vote on the 13th, yesterday, on the Omnibus package. So we've seen some changes. Many sustainability advocates are saying that the reporting rollbacks that have been passed by the EU Parliament just yesterday, they've gone too far. So, for example, now the reporting requirement under CSRD applies to companies which have at least 1,750 employees and at least 450 million euros in revenues. And previously, that threshold was 250 employees and 50 million euros. Okay, so those companies in scope have reduced quite a bit. And if we look at the new requirement under the due diligence regulation, what is known as CSDDD, it applies to those companies which have at least 5,000 employees and revenues of 1.5 billion euros. Previous threshold was 1,000 employees. And then there's also, by the way, there's no requirement for companies to prepare transition plans, which I think many of us feel is a major step backwards. So these are just some of the key changes that have happened, that have been passed just yesterday, as I mentioned. And I should also mention that EU member countries will now have more control over some things in their own laws, such as penalties they can apply to those who don't meet the reporting requirements, and laws over civil action claims, which, it kind of makes sense. So I do believe that, look, some of the changes are necessary because the initial set of regulations that came out did go too far, in my opinion, some of them, and I think others have that view too. But my sense is that the rollbacks have gone too far. And now the next step for the EU Parliament is, they're going to have to negotiate with individual member countries to pass all this package into law, which is expected to happen by the end of this year. And I do see this happening. I don't think we're going to see major changes. So that will have an impact on data, obviously, in reporting.
Interesting. So it definitely resonates with me because a lot of the industry professionals are also saying that maybe it was too much to ask. I think there was like 30,000 data points to be collected by the companies. And I feel the infrastructure was not there yet fully, especially when it comes on the assurance side. So at this point, I guess what you're saying is that we took 2 steps forward, 1 step back today, and then this will be an ongoing negotiation process.
Well, we took 2 steps forward and maybe 3 or 4 steps back.
Oh, so are you saying we're actually worse off than it was before the CSRD, ESRS?
Yeah, because the issue isn't necessarily around how big the company should be. Although that is an issue, you do want to reduce regulatory reporting burden on companies and perhaps not have reporting requirements for some companies that are too small, let's say. And the whole issue of what did you say, 30,000 or 3,000 data points, whichever one it is, it's ridiculous. And a lot of this is the company, both the regulators and the market are still learning. There's a saying that we often use, right? That we're building the plane as we're flying it. But I think that there's a little bit of lacking of humility in that phrase, because that assumes you know how to fly the plane. The better phrase is, we're building the plane as we're still learning how to fly it. And I've given input to the regulators, the Institute of Chartered Accountants here in England and Wales. I'm not an accountant, as you know. I've given input in Canada through my involvements with the Ivey Business School and the Smith School of Business and in other ways. Regulators themselves are learning. And when we talk about this in those sort of forums, they're nodding their head and they acknowledge that. So it's an issue of focusing on, which we will get to, decision useful information. But if you don't mind, I also want to highlight a couple of things that maybe you or your readers are familiar with. So Morningstar recently came out with a survey. They surveyed over 500 asset owners, and I believe 11 countries, including North America, Europe, and so on. And what they found is that 55% of asset owners consider ESG regulations to be helpful, whereas just 27% said that they are a hindrance. And 46% said that ESG or sustainability regulatory rollbacks, such as what we just discussed, are steps in the wrong direction, compared to 27% who said that they are in the right direction. Because this omnibus package is being discussed and negotiated before what was passed today. And then another survey by Bain and Company, they analyzed statements of 150 CEOs of leading companies, and 54% said that sustainability is, adding value to their business. And that's quite a significant change compared to 5 years ago. And interestingly, 26% of them said that their companies are not using suppliers which do not meet sustainability requirements. And 49% said that they expect to do the same within the next 3 years. And if I'm not mistaken, something more recently, about 200 investors and others, mostly in the EU, signed a joint statement calling on the EU to not roll back too much of CSRD, SFDR, and all that before it was passed today. So maybe their statement didn't make that much of a difference, because the market is saying that, hey, we need to see this stuff because climate change risk and a just transition do pose material financial risk to us. So please don't pull back too much. But there are politics here involved and perhaps some less than sensible concerns about the economy. So let's see where the dust settles. It'll be interesting to see how the market responds to all this.
This episode is brought to you by ED4S, the sustainability training solution designed for scalable workforce training. ED4S makes it easy to build, launch, and maintain time-efficient, role-specific sustainability training for your teams. Developed by industry experts and trusted by leading organizations worldwide, visit ed4s.org to download a free case study and see how ED4S can work for you.
That's actually an excellent segue to my next question. And just to mention about the point in terms of the requests of the ESG compliance or reporting, I just had a conversation with a sustainability leader from a US-based global company. And they actually document how many RFPs, most of them which are coming from Europe, actually have ESG requirements in terms of disclosure. So they're actually able to put a dollar amount on the opportunities that come with the ESG disclosure requirements. So even though in the US, they don't have necessarily much of a disclosure regulation, indirectly they're being pressured and they can actually evidence the value of this disclosure, because those RFPs that they're applying for wouldn't even be available if they didn't disclose the ESG data.
Yeah, it depends on the company, depends on the state. California is moving ahead, even though some are challenging the new laws. Illinois, New York, Colorado, Washington State, they're all kind of moving ahead.
Yeah.
But I would also caution people to not think that there's one or two standard ways of quantifying ESG data. It's still an evolution, this whole area of how to use the data to quantify it. Some of it is a bit more obvious. Some isn't, which we can talk about.
Yeah. So talking about the data in financial decision making, and this is a topic that's very close to my heart, because as an investment analyst that's on the side of investment decision making, valuation, at the end of the day, we need to know what to do with these data points, right? So even though we could have all these 30,000 ESG data points on the company, it's impossible to apply all of that. And the challenge comes down to identifying which ones are useful and how to use them, how to apply them in due diligence, in valuation. And that's what I would love to dig into today. Can you tell us, first of all, can you define what is a financially decision useful ESG data in your opinion?
Yeah, and it's not my opinion. This is not a theory that I've come up with. I'm trained in this. The international development, DFIs and others of the world get this. They've been doing this for years. The business community, the finance community is new to this. They've got to change the way of their thinking. And back in 2011-12, when I was doing this sort of work, a good friend of mine who was actually a specialist in international development work and said to me, you really should take this course because it'll fine-tune your thinking. And the course is no longer available. And it really shaped my thinking around this, what we now call theory of change framework. And that applies across the ESG landscape. So let me get into this, and I'll walk you through some examples, okay? But before I do that, anyone that is capturing thousands of pieces of data should just stop and say, this doesn't make sense. Even large companies. Now, you might need to capture some outputs data, but it's really the outcomes focused data that we need to think about. So let me give you some examples. We need to think about ESG data in terms of decision useful outcomes. Output data is activity-based. They don't tell us if a positive or intended change has actually happened. So examples of output data in the ESG space, let's say, is, for example, the amount of funds that companies invest in renewable energy or in energy efficiency measures, or how many employees they've trained, a company's trained on anti-bribery and corruption policy, or how many of their suppliers have adopted the company's human rights policy, or even how many of the company's suppliers, or a certain segment of their suppliers that they've prioritized, have set net zero targets that, let's say, have been validated by the Science Based Target Initiative. Those are all necessary things to do, but they don't tell us if change has happened.
Absolutely. It's almost like checking the box.
Well, it's a necessary checking the box.
Yeah.
And somebody does have to capture it and say, hey, did we do this? Because it's like you can't get to pre-tax profit without having revenues and without ticking the box that you've recorded revenues. Okay? And that is an analogy that people should keep in mind. I'm going to come back to that in a second. Now, if we use those same examples, okay, and then apply a decision useful outcomes way of thinking about it, examples of that decision useful outcomes would be, let's say, the reduction in greenhouse gas emissions resulting from the renewable energy investments, and better yet, actually, the reduction in emissions on an intensity basis in that company. So let's say such as emissions reduction per dollar of revenue, okay? If they've implemented or put money into energy efficiency investments, then what you want to measure or the decision useful outcome would be the reduction in kilowatt hours usage per unit of production, okay? If it has to do with the anti-bribery and corruption policy that your employees are trained in, you want to measure the number of incidents. Have you seen a reduction in that? Have you seen a reduction per 1,000 employees, per 100 employees on some sort of a relative basis? Or if it has to do with requiring your suppliers, let's say your tier one suppliers, because many companies have a lot of suppliers and they have to prioritize, then have they reduced human rights violations if they have identified some concerns before doing this, reduce the number of violations, human rights violations in those suppliers? That is what actually has to be measured. Or if they've set net zero targets, then obviously you want to measure, have they achieved those targets? Now, this is not rocket science, and a lot of people might find this obvious. I've conducted 30, 40 workshops for different organizations, for bankers, for accountants, including accountants in Canada, by the way. It's a certain way of thinking that needs to be done. Okay. Now, we can talk about some of the challenges in capturing this information in a second, which I'm sure you're going to want to talk about. But the first thing is this decision useful? Because if you're still left with a so what question, you can't then take that number, apply it in some sort of a model or multiple or discount rate. You don't have the right data to then use it for some calculation. So let me just stop there and take your thoughts on that first.
Yes, there's a lot to unpack here. And what I wanted to just comment on is that translation between those operational metrics. You mentioned the emissions intensity per dollar revenue, for example. So we could track that. Now, what do we do with that information? Let's say we're able to identify and it's reliable. I guess we can compare with the peers, or we can compare with previous years. So it's a relative assessment. How can we translate that into a financial statement? I know that we don't have the answers to these questions yet, but I think it's important to acknowledge that financial analysts, portfolio managers are not equipped to be effectively translating this into dollars. And I think the one closest example that I came through, it was through the FSA, the SASB training, where they basically apply this to a cash flow, discounted cash flow models, and build it into whether, CapEx expenses that may come up or the impacts on the costs. So this piece of translation of the ESG metric that could be decision useful all the way to the dollar amount. What does it mean for my balance sheet, for my financial statement?
Yeah.
Have you seen anyone doing this effectively? Maybe give us some examples, maybe in due diligence, maybe in valuation.
Yeah. So just to remind you and your listeners, I've done due diligence for private equity on these issues. Given my finance background, I've run valuations and all that, right? So one has to understand, okay, how do I take this information to do it? And anybody who has done valuations will know that they have to take certain qualitative data, because not everything is quantitative in due diligence, and then say, okay, what do I do with this? Quality of a property, quality of an asset, quality of a customer base. Yeah. So pre-ESG thinking, we already had to do this. And there were certain precedents because we had more history of how people were applying this and valuation, best practices, and so on. We're still evolving in that. But I'll talk about a little bit of this, and I want to make sure that you and others don't think that there's a precise way, okay? So for example, investors, for example, are looking at greenhouse gas emissions, right? The first thing is, are you looking at the right information? If you're only capturing outputs data, how much have they invested in renewable energy? Or how many new megawatts of renewable energy have they purchased? How are you going to put that into evaluation? You need to see what has it actually done for that company. That's the first thing that I really want to stress. You want to look at things like 2030, 2040, 2050 targets. You want to look at things like, are they validated? Are those companies and their targets on pathways for the companies and peers and related to the industry averages? You can then take that and say, there are different companies will apply it in different ways. They'll apply it on a multiple basis. They'll apply it on a discount rate basis or both. Right? They might make some adjustments to certain expenses using, let's say, if they're not on track to achieve their greenhouse gas emission reductions target, or on track that the investor thinks they should be on, then they might say, I want to apply a carbon price on the delta, on the difference between where they are, where they're heading, and where they should be. And that difference in the greenhouse gas emissions, I'm going to apply a carbon price on it. Mm-hmm. And I'm going to put that as a cost, operating cost.
Interesting. So you're pricing externality.
Yeah. Because at the end of the day, again, I've worked on these issues like you have, but when you look at it over a period of time, and when I talk to private equity and bankers and others, say, 3 years ago, 5 years ago, were you having to look for this information? Forget applying it into your models. Were you even asking for this information, looking for it? Most of them would say no. So where do you think it's going to be in 3 to 5 years from now? And when you go to sell the asset or refinance the loan or whatever it might be, exit in some way, what do you think the market is going to do when it comes to looking at this data? Will they incorporate this somehow more into their valuations? And they always say yes. We're also seeing these sort of things, as you know, in financing agreements, terms and conditions in that, right? So they are popping up. And they're popping up, certain industries, the banks and others are saying these are higher risk, higher emitting industries. We need to implement the terms and conditions, ESG metrics into the financing terms and conditions. But how they apply it is one example. By the way, when it comes to a balance sheet, I've talked about P&L, stranded assets, impairments, and that takes more time. But if they're not doing the investigation and looking for outcomes-based data, they won't have enough clarity on where the stranded assets might be. Okay, they might have to make too much of a leap in assumptions if they're only looking at outputs-based data. So I really want to emphasize that.
And I think that's where the time frame really comes into play, because if you're investing just for the next few quarters, including the stranded assets may not just make sense. So it's definitely a challenge for analysts who are very new to this. I mean, we're talking about systems thinking, systemic risks, and how do you price that? And then once you price it, maybe you do have the ultimate truth, a better valuation, but when will the market catch up to reflect that valuation as well? So there's a lot of challenges, and I'm wondering if there's a role for organizations like CFA Institute or just finance thought leaders and think tanks to try to come up with maybe methodology or a process to just help the industry do this better. What do you think?
Well, it's already happening. If you look at, companies like Sustainalytics, CDP, EcoVadis, and others, they have ratings, and then people can use those ratings. They do an analysis, right?
There's a lot of backlash on ratings
Sure,
too, right? It's very...
Sure. There was a lot of backlash on the ratings, rightfully so, in the financial crisis. Absolutely, right? I mean, for those of us who've seen the movie The Big Short, will remember all the details around that. So yes, there is. It's an evolving space, and we need regulations around it, which I hope Canada introduces, is something that I've advocated with UK, EU, India, and other countries, jurisdictions are introducing or in the process of introducing regulations around it. But think about it. They're the experts in capturing data and thinking about what data is needed. By the way, CDP is a former client of mine, so I have a little bit more insight on that. And I've challenged them on some of this, and they're doing a lot of good stuff in terms of capturing the right decision-useful data and then using their approach to come up with the rating. And then it's up to those who want to use that rating to then interrogate the underlying data and to apply that rating somehow into their valuation. This is an evolution. We shouldn't be afraid of this. IFRS, by the way, is only, 22 years old? IFRS.
Yeah. And we only have financial accounting for like 100 years, not more than that.
Yeah, and IFRS itself is evolving. It's only 20 years old.
Absolutely.
Right? And it evolves. So we've got to start somewhere. And if we don't focus on decision-useful outcome metrics, then it's going to be even harder to do that. So I really want to emphasize that.
You made me think about the comment actually Nawar El-Sadi made yesterday in the conference. It was talking about what is our common truth. And when it comes to the rating agencies, as you know, currently they're a bit all over the place. You have completely different ratings on ESG between one company to another because the methodologies are all different. So I think at one point we will need to come up with one common truth to be more credible in the market and just come up with a common approach. You don't think so?
If that was the case, we would have a very similar approach or one approach with all the current rating providers.
They're very similar, though. If you compare, there's not that much variability.
They're similar, but it's not one. They're similar, but they do it differently also. They also do it differently. I mean, S&P, Moody's, MSCI.
They ask for different things, but you never see the same country or company being rated A in one and C in the other one, which is the case right now with ESG ratings, right?
No, but people have to take responsibility, Maria. We have to realize that this is early days.
Yeah.
Geopolitics, the landscape is evolving. We can't just pass the buck on to the rating providers. We've got to use common sense around this also and focus in on what data is useful. And that's why I said at the beginning, if anyone's capturing thousands of pieces of data, you got to stop and say, hang on, this doesn't make sense. Why am I doing that? Why are we doing that? Now, you might need to capture a lot of the data, but you don't need to report it because you do need to capture the revenue line items as an analogy I would use. And I use this analogy in my workshops. If you've got 1,000 products, you've got to capture the revenues for those 1,000 products. Do you report that in your financial statements, each one of those? Of course not. You consolidate it, you might break it down by division or whatever. Would you just stop at gross profit on your P&L? No. People want to know EBIT. They want to know after-tax profit. Well, outputs are the equivalent of gross profit. And I look at this information on a regular basis. I advise companies on it. I say, if we want to then apply this thinking into evaluation, and at the end of the day, it's about risk management and value creation, we need to get to the equivalent of the EBIT and after-tax number, which is the outcomes-based data, that examples I gave you, right? We can't just say, well, the rating agencies, it's their job. And yes, it's 5 years since they've really started to focus on this. Let's see where we are in another 5 years, another 10 years. And by the way, the regulations are the regulations around ESG rating providers is going to come in, where they are talking about what you're saying, some standardization. So I think if we were to have this conversation 3 to 4 years from now, I'm quite sure it'd be different. And if it isn't, people will, including myself, will be in an uproar.
Yeah. So let's talk about that part of identifying, gathering, and some of the challenges that you see among your clients. Can you give us some examples? Maybe could it be industry specific or a topic specific type of ESG data gathering?
Well, it is around, do you know what you want to gather? So if you stop only at the outputs level, i.e. revenue and cost of goods sold, as an analogy, then you're not going to know outcomes, right? So we need to know that. In-house training is a real issue on these things. People are learning. It's not rocket science, but people are learning and they're under pressure. Putting in the systems then, anybody that's developed or helped implement or design, not implement, but design an IT system knows the importance of this, okay? So IT training, internal commitment. If you don't have commitment at the board level, the management level, if they're not collaborating, you can't just say the chief sustainability officer is responsible for this. IT, CFO's office, procurement, HR, and importantly, if it's not in compensation metrics, if ESG metrics are not part of not only CEO and CFO, but throughout the organization, or at least in certain parts of the organization, then chances of them happening are not going to happen because, the saying is, as we know, if it's not measured, it's not managed. So those are some of the core challenges.
Yeah. So definitely defining the right metrics, especially when it comes to the compensation. That's certainly a big challenge given that we're dealing with different functions, different responsibilities, and they don't all have the same control on all of these different things.
Right.
Maybe last words for our audience today.
Well, I think one of the most important things here that we're not talking about is the importance at the board and the senior management level. If they don't know what questions to ask themselves, then it's not going to trickle down. And I just spoke about that at a conference. I was asked to speak about that at a conference. So we can talk about data all we want and all that and how is it applied. Where I see the biggest challenge in all this, in implementing what we've been talking about, is understanding at the board and the senior management level. Do they know what questions to ask so that they can get the answers to them if they don't have the answers themselves? Is there enough commitment at the board level? Or is it just one individual that's kind of on the side of the board and once a year talks about it? Which committees of the board are responsible for this? Is it also part of the audit and risk committee? Is it a nominations remuneration committee? If it's a private company and a small company, does the advisory board have a role in this? On and on and on and on. Okay. And how they deal with their suppliers, being pragmatic about this, using proper incentives, both sticks and carrots, is also very important. And perhaps when we have more time, we can talk about this. But I want to leave the audience, your listeners, really reflecting on the importance of that.
And one of the challenges that sustainability leaders often enough only get like 5 minutes, one slide to talk about sustainability. So being extremely effective on using that decision useful, financially material, or connected to a business value data to demonstrate that this is actually risk. And if we're not capturing today, this will be a loss tomorrow. So preventable surprises.
Well, yeah, but again, it depends on your geographic scope.
Correct.
Europe and UK are definitely further along than Canada and North America in general, which is one of the reasons why I think I've been asked to provide some input in the Canadian market. And European companies are further along on this. They do give responsibility to the nominations and remuneration committee to address these issues. There is a sustainability committee increasingly in larger companies. Also, there's also a mandate given to the audit and risk committee that are you looking at these things? And then those three committees and others are required to collaborate and talk. So, to your point, which is a valid point in some companies and in certain geographies, is it 1 page, 5 minutes? Is it a standing agenda item that's given 15, 20 minutes at each meeting? And then what about at the executive senior management level? So yeah, you raise an important point. If it's not a commitment at that senior level, then doing all this stuff is far less likely to happen. And in my experience over the years, this is where I see the biggest problem.
So we'll leave our listeners with this point and to reflect on how to address it. You can find Pyarali on LinkedIn. He's got many other resources and also participating in other webinars that you could listen to. It's been a real pleasure, Pyarali, to discuss this with you today, and stay in touch.
Thank you so much for involving me.
If today's episode sparked ideas for your team, visit ed4s.org. That's ed4s.org to explore our customizable corporate learning solutions or book a quick discovery call. You don't have to figure it out alone.